For most people, financial danger only feels real when markets are crashing on live television, when red numbers flood the screen, when headlines scream panic, when politicians rush to reassure the public. But what if the most dangerous financial shock doesn't look like that at all? What if the real crisis is already unfolding quietly behind closed doors inside the largest investment funds in the world without anyone ringing the alarm? Because right now, big funds are taking losses that most investors never see. Not losses reported on the front page. Not losses marked clearly in public markets, but hidden losses buried in private valuations, delayed accounting, and complex structures designed to smooth reality. And history tells us something uncomfortable. When losses are hidden, the final shock is usually worse. This is not a story about a sudden crash. It's a story about slow pressure building inside a system that depends on confidence, stability, and constant refinancing. And the question is no longer whether losses exist. The question is how long they can stay hidden before the system is forced to face them. To understand why this matters, we need to step back. Because financial shocks never start where people expect them to. They start where risk feels controlled, where returns feel steady, and where investors believe they are protected by complexity and scale. For decades, the global financial system has been built on one simple idea: growth through credit, borrowing fuels expansion. Lending creates opportunity, and leverage magnifies returns. When used carefully, this works. But when it becomes a habit, it changes the system itself. After World War II, credit was mostly straightforward. Banks lent money, businesses repaid it, losses were visible, failures were local. But as economies grew more complex, finance evolved. Bonds replaced loans, markets replaced relationships, and risk was spread across layers of institutions. By the late 20th century, finance had become faster, bigger, and more interconnected. Innovation allowed risk to be sliced, packaged, and sold. At the same time, responsibility became blurred. When everyone holds a piece of the risk, no one feels fully accountable for it. The first major warning came in the late 1990s, when hedge funds nearly destabilized the system. Then again in 2008, when mortgage losses spread through complex securities that were supposed to be safe. Each time, the pattern was the same: confidence, masked, risk, complexity, delayed recognition. And when reality finally surfaced, the shock was enormous. After 2008, governments promised reform, banks were regulated more strictly, capital requirements increased, risk-taking inside traditional banking was limited. On the surface, this made the system safer. But beneath the surface, something else happened. Credit didn't disappear. It migrated. Instead of banks, large investment funds stepped in, asset managers, private equity firms, pension-linked vehicles, and private credit funds began providing financing to companies, real estate, infrastructure, and governments. These funds operated outside traditional banking rules. They offered higher returns, they promised stability, and they attracted enormous amounts of capital. This was the rise of the modern fund-driven financial system. At first, everything looked calm. Interest rates were low, defaults were rare, asset prices rose, funds reported smooth performance quarter after quarter. Investors became comfortable, confidence grew. But this stability was not natural. It was engineered. Low interest rates allowed weak borrowers to survive. Refinancing became routine. Losses could be delayed indefinitely. Valuations could be adjusted gradually instead of mark to market. And because many of these assets were private, there was no daily price to challenge the narrative. This is where the seeds of hidden losses were planted. As money flooded into funds, competition increased. To maintain returns, managers took more risk. They lent to weaker borrowers. They accepted fewer protections. They increased leverage. But because the system was quiet, few questioned it. Then conditions changed. Inflation rose. Central banks tightened policy. Interest rates climbed rapidly. Suddenly, the assumptions holding the system together began to fail. Borrowers faced higher costs. Refinancing became harder. Asset values stopped rising, and cash flows tightened. This is where cause turns into consequence. Higher rates increased debt service. Higher debt service reduces profitability. Reduced profitability increases default risks. Rising default risk forces restructuring, and restructuring exposes losses that were previously hidden. But unlike public markets, where prices fall immediately, private funds do not adjust instantly. They use models, they assume recovery, they spread losses over time. This creates the illusion that nothing is wrong. Yet beneath that illusion, pressure builds. Large funds are now quietly marking down assets. Not dramatically, but gradually. They extend loan maturities, they renegotiate terms, they delay recognition. This keeps reported performance stable, but only temporarily. At the same time, investors begin to notice something else. Liquidity is disappearing, redemptions are delayed, withdrawals are limited, capital is becoming trapped. This is a critical moment in any financial system. When money goes in easily but cannot come out freely, confidence begins to crack. The breaking point arrives not when losses appear, but when trust erodes. When investors realize that reported values may not reflect reality, when they understand that exits are limited, when they sense that time, not performance, is being used to manage risk. That stage, small shocks become dangerous. A few defaults turn into many. A few valuation cuts turn into broader repricing. Funds that rely on steady inflows face pressure. Those pressure points spread across portfolios, institutions, and markets. This is how a financial shock builds quietly. The fallout does not arrive as a single event. It unfolds in stages. First, underperformance, then restricted liquidity, then confidence loss, then forced selling, and finally, recognition. And because many of these funds are deeply connected to pensions, insurance companies, and retirement systems, the impact spreads beyond markets. It affects real economies. Investment slows, hiring slows, risk appetite collapses. What makes this moment particularly dangerous is that the usual fixes are weaker than before. Central banks face inflation constraints. Governments face political resistance, and private funds are not easily supported without creating moral hazard. This means losses must be. History tells us that systems built on delayed recognition tend to end abruptly, not because problems suddenly appear, but because they can no longer be postponed. We've seen this pattern repeatedly in structured credit, in real estate bubbles, in emerging market debt. Each time, the story sounded different, but the structure was the same. Smooth returns hid growing risks. Complexity delayed awareness. And when confidence finally broke, the shock was severe. Today's version is hidden inside large funds. The parallels are clear. Rising leverage, falling transparency, dependence on refinancing, and growing pressure from higher rates. So what does this mean going forward? It means the financial system is entering a phase where stability depends on time, not strength, where performance depends on assumptions, not cash flow, and where confidence is more fragile than it appears. The three lessons are simple but critical. First, hidden losses do not disappear, they accumulate. Second, liquidity is only real when it is available. And third, confidence breaks faster than it builds. The warning is not dramatic, but it is serious. The next financial shock may not arrive with a crash. It may arrive with silence, with gated funds, with with quiet losses spreading through institutions that most people trust. And by the time the shock becomes visible, options may already be limited. If you want to understand what's happening beneath the headlines before the story changes, stay with us, subscribe, follow, and keep questioning the calm narratives. Because in finance, the most dangerous moments are often the quiet ones.